Jay, did I ever tell you about when I went and visited AJ? How he was like, "Oh, let's go out to lunch," and we went to the restaurant, and literally, like, we walked in, they're like, "Mr. Osborne, would you like your table?" And then he's like, "Yes, please." And they walk us all the way out to like this window in the back corner, and they're like, "Will you be having the usual?" And he's like, "Yes, I will."
He arranged that like 10 minutes before you showed up just to make it look like he was cool.
Maybe, but it was one of those like things that you see in like mob movies, but you don't actually think happens in real life, where it's like someone goes and they keep ordering the same thing enough that they're like, "Oh, would you like your usual?" But apparently, no. AJ is that guy.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 43 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and we have a very special episode here. We had a lot going on in the economy and geopolitics, so we knew it was going to be a super smart episode that we had. So we decided to kick Mauricio off. Mauricio's not well suited to those types of episodes, and instead we brought on Miss Anna Kelley. Anna, how's it going?
I am doing well. Thank you for that very kind introduction. I don't know if Mauricio would think I'm smarter than him, but I'm honored.
Well, Anna is a partner with us on a few deals, multifamily investor. She's super smart, very good friends with my wife, Ashley. I know they meet regularly, do some masterminds and stuff, and a lot of their stuff they talk about goes over my head. So why don't you tell the audience a little bit about yourself?
Great. Well, most importantly, like you said, I'm friends with your wife and partners with you guys on a couple of deals, which has been amazing. Before I got into real estate and syndicating multifamily, which is primarily what I've done over the last 5 years, I started in real estate in 1999 after starting out in private banking. For Bank of America, I was a top private banker for Bank of America in Houston, Texas. And that's really where I started to learn about wealth and what to do, what wealthy people do with money and how to tell them to invest. And I realized that my wealthy clients had real estate and I had learned nothing about it. And so I started kind of learning about real estate on the side, investing, went from Bank of America to AIG for my full-time gig where I worked for 20 years through the GFC, and then built my own wealth on the side through real estate, not through any of the things I learned about institutional investing. But I basically have a lot of experience in the financial services sector, and then in the real estate sector as well. I've done about 300 million in real estate across single family, vacation rentals, multifamily, etc.
Awesome. Did you bring a drink along with you to in support of our podcast?
I brought myself a Diet Dr. Pepper, which is like my biggest vice. And I haven't had one in 3 months. So I thought, I'm going to let myself have one. It's almost like having a glass of wine for me.
Fell off the wagon just for us, eh? You're on AJ's train?
No, my goal was 3 months. My goal was make it 3 months with no Diet Dr. Pepper. And then I'd allow myself one on occasion because it's not good to just go cold turkey or we will mess up. So this is my reward for being on the show with you guys and for making it 3.5 months.
You have competition, AJ, for who's driving us home.
That's right.
AJ, how's it going, buddy?
Doing good. How you doing?
Good. Nothing going on. You're just doing good,
dude. I mean, how could I be doing better? I'm on the podcast with you guys. This is good. This is my highlight of my week.
I mean, something must be going on. You are looking high and tight right now. That haircut, like that must have been like an hour ago.
It was a couple days ago, but it does look an hour ago. That's so fresh.
You red Solo cupping again?
You know it. Fountain drink, Diet Coke, all the way.
Hey, Jay, what's up, man?
Been about a week and a half since my haircut, so you don't need to compliment me. I know you want to, but you don't need to.
You got a bit of a halo glow going on above your head. It makes you look very saintly.
I need to fix the lighting in my office. It's really bad, and it's getting towards dusk, so the light coming in from the window isn't good. It's a bad time for me.
So you're probably over your hangover from Best Ever Conference by now. So you back drinking with me?
I'm back drinking. I also want to say, because I don't want anybody to think that we don't love Mauricio. We did not kick Mauricio off this week. He had to take the week off for some other stuff that he was doing. But I will say that once we decided that this was going to be an economics-based episode, that like the choice for who we had fill in was absolutely abundantly clear. And so I called Anna not long ago, and literally, I mean, she's doing this on about 6 hours notice. So she's a trooper. But the funny thing is, she'll probably like know more about the stuff we're talking about than us who've had time to prepare. So for anybody that thinks like I'm good with my economic stuff, just know that like all I do is listen to Anna and then just regurgitate whatever she says.
In fairness to us plebs, she found out 6 hours ago. We kind of solidified our topics like 10 hours ago. So it's not like we had that much more lead time, but still, it is a short time frame in order to talk about this type of stuff.
Well, I'm honored. A little bit of pressure there with that setup, but we'll see.
Well, I'm going back to the well. This is kind of one of my old faithfuls. When in doubt, I go with the Woodford Reserve. I feel like it's one of the best price to quality ratio bourbons out there. So,
and you didn't ask me what I was drinking.
Yeah, that's true. I did ask you if you were drinking, and
if, but not what. So
I went on a tangent about Anna without going into detail. So I'm going to blame that one on you, actually.
So I'm going with an old standby. Also, my Oberon from Costco. So my daily drinker.
You're using it too much that I can't even make the Costco joke anymore. It's not. But even
it's
funny.
True. This we buy this by the case from Costco. $18 a bottle, by the way. Highly recommend.
I can't do red wine because it gives me a headache if I do red wine. I've tried to do red wine, but I always have a headache. What is it about that does that?
You got to go a few dollars higher. Get the ones without as many tannins, and you also have to let it sit out for like 20 minutes. So some of the gases kind of come off, and you're gonna get a lot less headaches that way.
Okay, I rarely have red wine unless I'm at like a really nice restaurant with a steak and it's supposed to be the best wine, but it still gives me a headache. So I do white.
Pay attention, everyone out there. If you become a real successful real estate investor, you too can afford $18 red wine.
Hey, can I tell you, last week at Best Ever Conference, Mauricio took me out to not one, but 2 dinners at the Capitol Grill. So I will say, when it comes to wine and steak, Mauricio.
Wait, just the Capitol Grill? He didn't hit sushi? Because Mauricio is classic for going to a sushi place and ordering everything on the menu, so that I'm convinced the reason he does that is he's like forcing them to bring out those big boats. You know, the big boats at the sushi place that you see up on the shelf, but you never really get. I think he just purposely orders enough so they have to bring him the boat.
Mauricio and I have about a half dozen different restaurants, sushi restaurants, where we've gotten the boat, and we always pick sushi when it's possible. Salt Lake City apparently does not have really good sushi. Apparently, they don't make good fish in the mountains.
Oh, really? No white tuna in the lake there?
No, apparently not.
All right, let's get into this. It's probably going to be a shorter episode, as Jay said. It's only two topics, but we might get a little political with the second one. So who knows? We might be screaming at each other all night. We'll see how it goes. But first, with everything going on overseas, it might be easy to forget that there was a major inflation print last week, and it was not pretty. March saw a third consecutive 0.4% increase month over month, crushing expectations and all but cementing the higher for longer sentiment. With the odds of the rate cut now in June only at 18%, my question is, Jay, is the outlook for real estate investors as bad as it currently looks?
So I wasn't ready to say that just after the CPI print, which happened like literally a couple hours after we recorded last week. So we couldn't talk about it last week, but a lot's happened since then as well. And even Fed Chair Jerome Powell came out today. It's Tuesday. It's the day before this episode's released, and basically said a lot more clearly than he said in a while that we shouldn't expect any rate cuts in the near future. It could be the end of the year before we see one, and I take that to mean that we may not even see one this year. So CPI is one thing to worry about. Like you said, 0.4% for March, expected to be 0.3%, so it's a little bit higher, but the bigger issue is that it pushed up the annual number to 3.5%. So in the last year, we've seen inflation grow 3.5%, which is the biggest number since September. And remember, we're targeting 2% or maybe a little bit higher than 2%. And so while 3.1, 3.2, what we've seen over the last couple months, isn't horrendous. I mean, it came down from 9%. It's not horrendous, but the fact that we can't seem to break down through 3 and we're creeping back up to 3.5, it's a little bit of a concern. Also, where we're seeing the spikes in inflation is a concern. So gas and shelter contributed over 55% of that increase last month. And so we've talked about the fact that maybe shelter costs are still lagging a little bit, but it's been over a year. And so, and we're starting to see rents continue to go up, or not starting to see, we're seeing rents continue to go up. We're seeing housing prices continue to go up. So there may be some continued inflation in shelter, but the other big one is gas prices. Gas prices are through the roof, and I don't see that coming down anytime soon. So CPI is the big thing that came out last Wednesday, but it's not the only thing. So since then, obviously, we've had some geopolitical turmoil. We've seen an escalation in the war in the Middle East, and that has led to a spike in treasury yields. So the 10-year is now over 4.6, which is crazy. I mean, middle of last year, we hit 5, and then Jerome Powell basically said, yep, we're going to see some cuts in 2024, maybe 3 cuts in 2024. That made everybody really excited, and we saw a drop in treasury yields, the 10-year under 4. But now we're back over 4.5%. Turns out that investors don't like to be in fixed return assets when we're seeing high inflation. So money is starting to move out of bonds, and when money moves out of bonds, the yields go up. And that's bad for us as real estate investors because higher bond yields mean higher mortgage rates. It's bad for everybody else because it just means higher borrowing costs in general. And so treasury yields is an issue. And then the other thing that we're really starting to see is just with bonds in general, it turns out that a lot of the bond auctions recently are having trouble selling some of these longer term bonds. Even shorter term bonds are not selling as well as expected. And so in the first 3 months of this year, this is an interesting statistic. The Treasury sold $7.2 trillion in bonds. And remember, bonds is how the government raises money. It's how we fund the country. And the fact that we needed to fund $7.2 trillion just in the first 3 months of this year, that was more than we had to do in Q2 of 2020, right after COVID. $7.2 trillion in bonds. And so when we're issuing all of these bonds, and we've got another $9 trillion to go, we have another $9 trillion in bonds that are going to expire and turn over this year. With all those bonds being rolled out and auctioned off, at some point we're at risk for some of the demand drying up. If different governments don't want to buy those bonds, if investors don't want to buy those bonds, well, what happens? Less demand, higher prices, lower prices and higher yields. And so if we see kind of an issue with selling bonds over the next few months, we could see treasury yields go even higher. So long story short, CPI was bad this month or last month. We're seeing issues with bonds. One good number that came out of the economy this week was retail sales, super strong. But I mean, while that might be good in a normal economy, I'm not sure we want to see good retail sales right now because that's just another checkbox on the inflation side of the ledger, and so that's a little concerning. So long story short, things haven't gone off the rails yet, but I think we're starting to see some cracks, and I'm not super confident that we're going to see a nice smooth sailing through the rest of this year.
Can someone explain to me how fears of a escalation in a war overseas leads to the 10-year treasury going up? I don't know how that happened. I mean, I saw what was going on, and I immediately said, okay, flight to safety, right? People are going to, there's uncertainty in the world. People are going to do the flight to safety. They, demand, supply, demand's going to go up. 10-year treasury is going to go down. And it didn't. To Jay's point, it was already a little bit higher after the CPI. We already got, 4 or 5. But it's 4.65 now. Like, I guess I don't see why the pop because of what's going on overseas.
Inflation. It was a target thing when you start to realize that, oh, great, oil is going to go up to $100 a barrel on top of the inflation that we already have. So that means that they're going to drive rates even more to kill global demand, which they've already cut output. And I think once again, I don't know, it's kind of like what been saying for a while now. I was like, I don't think they're not only going to even cut rates, I still think that we have a good chance they will increase rates this year. And I know that was crazy, literally just 4 months ago, but what people were saying didn't seem to match reality on why we were going to get all these rate cuts and everything else, where it's like, but it's not happening. Main Street, we're not seeing prices drop. We're not seeing any of those things. And the Fed is way too concerned with it, right? And rightfully so. We already saw, we had a test subject in the fall, and we saw all they did was mention it. And what happened? Boom. It just exploded. They had no room to be able to drop rates. I think that was more of a hope and a prayer that something would continue, or this slump that was more of a seasonal even slump than anything, which we see every seasonal, would continue, and that it wouldn't jump up in the spring, which it just followed normal trend lines. So I think the market was so over, way too quick to rush in to think that rates were going to go.
But it swings so wildly, I guess, is my thing. Is I don't like, fundamentally, I don't get these swings, because like all of a sudden we have a bad CPI print and the 10-year treasury will go up like 0.25%, when like, okay, if you look at the forward looking markets and the rate cuts, like all that did was push back the expected rate cut like 1 month. But like the 10-year treasury is supposed to be the outlook over 10 years. So how is it swinging by a full 0.25% just because the outlook gets pushed back a little bit? Like they'll probably make up for it in 2025 with more rate cuts than they were expected. I don't understand how these 10-year treasuries just swinging so much on every single little piece of news.
Kyle, I think part of it is because, as we look at just what's been happening over time, economists are all over the place as to where are rates going. And what I've kind of come to view, at least my view, is, most economists, they're either macro guys or they really look at the minutia of the data. And they're either thinking about cyclical trends or secular trends. So the cyclical trend is like what's supposed to happen in the next 0 to 8 months. Some say this, the cyclical trend is maybe out to 18 months. And then you've got these long-term secular trends of where are things going long-term. And it's really been very, very difficult to guess where are interest rates going to go in the short term. Where is the inflationary cycle? Is this a feature or a bug, if you will, right? So not only was inflationary not transitory, part inflation, the question is, how long is it here? Are we still on a long-term deflationary track? Where everything's kind of going down like it has been in the US for the last 40 years, if it wasn't for government spending boosting GDP when we really haven't been producing as a country? Or are we in this blip of inflation that's just a bug, and once the Fed gets it under control, we're smooth sailing with a good, strong economy again? And I think that as time goes on and it takes longer and longer to kill inflation, and we see these jumps, the bigger fear, and why I think we have fears when we have escalating wars, et cetera, is that inflation is not just a bug, but we're in for a much longer secular trend of higher inflation. And when you have higher inflation over the long term, and you have the US government debt at the highest point that it's been per capita, at the same time that now the government not only, part of why inflation's still here is because of fiscal spending. It's from what the Congress is doing despite the Treasury. So the Treasury is trying to slow down spending. The federal government's pumping money in and growing our debt, passing our debt ceiling. And when the US gets to where a third of our receipts is paying interest, nobody wants to buy US bonds anymore, because they're basically saying the US could default because we can't make our interest payments. So when we have to now go in and back another war, and that causes more spending, and the future basically says for the US to produce enough GDP to get higher than inflation, the government's going to have to spend to bring production back to the United States through reshoring, through, deglobalization, energy independence. All those things cost money. And if the Fed has to keep, if the federal government, Congress, has to keep adding to our national debt at the same time that we're trying to fight inflation, that's very inflationary. Wars are inflationary. We go to battle, to back up Israel at the same time that Russia and Ukraine are there. It could be another huge energy shock. You could get OPEC trying to react. All of those things for the long term are really bad for the government. that just means we have more and more and more debt at the same time that we need to stop spending in order to bring inflation down. And so I think that the big players in the treasury markets, they understand this, and they're saying we could have a huge oil crisis like we did in the 70s. I don't know that it'll be that bad, but that could happen in the Middle East, especially with escalations in Israel. And then on top of that, not just the short term, what does it do to oil, but what is the cost of funding these wars at a time that the government only has three choices to get debt down? And that is cut spending, which we can't do. It is raise taxes, which they can't yet do, or it's caused more inflation. And so I think the treasury markets know that over the long term, even if the Fed gets control of inflation and we have a recession and they cut rates in the short term, over the long term, we're in for a lot more inflation. And I think that's why U.S. Treasury, markets have continued to rally and freak out and say, if we're going to keep buying bonds, we need a much higher rate to get us to play. And that means U.S. Treasury rates go up higher, even if the Fed does start to cut rates. The Fed has kind of lost control of Treasury rates, in my opinion.
Well, we're at the highest expenditures ever. We're doing over $1 trillion every 100 days, and there's no reason for it. So the government is spending at a rate that is unprecedented, even during economic catastrophe. They're spending at a rate that is unprecedented to that historically. We have high inflation. They make up 30+%, 35% of our GDP. You can't pump trillions and trillions of dollars after you already pumped trillions of dollars into a system and not expect inflation to not keep going. I mean, it's 35% of our GDP. Then wars, then oil. I mean, the outlook is horrible. And two, the thing about it is the outlook is this is government driven. The economy itself is actually not in a bad spot. That's the problem. The government's acting as if it is, and how it's the inflationary impact of the government as is if the economy was doing worse. So all of a sudden they're trying to calm it down by interest rates, but you can't do both. You can't spend at this level. You can't keep borrowing at this level, have wars, have all of these other things and inflation, and then try to cut interest rates. You don't get it.
Yeah, the one thing that I would just push back just a little bit on that is that I don't think the economy really is strong if it wasn't for government spending, because I mean, the government is making it worse with inflation. But over the last 40 years, we have not been a manufacturing producing country. In the 70s, inflation partly was high because we had a boom of young people entering the workforce and spending a bunch of money. Then we had these other shocks like wars and, the 1973 war in Israel and the OPEC crisis that followed that. But really, for the last 40 years, since we've been outsourcing production, most of our GDP that's been just enough over inflation that we've been a growing economy overall has been produced by a dollar of government spending. So the government, as we were on this deflationary demographic decline, was spending more and more money. But in good times, when interest rates are low and it incentivizes everybody to go at least create production through financial engineering, even if it's not through production, we can get by. But now the economy, 66% of American households are living check to check to check, have more debt than they've had. Companies are tight, going bankrupt.
If you want to look a bit on the rosy outlook, though, productivity is increasing pretty rapidly. Like we are hitting all-time high of productivity. The tech sector is obviously booming with the AI coming on. Like there is kind of, if you want to grasp onto hope, there is hope there, in my opinion, as far as, maybe we're not making as many things, but as far as what are we creating, it's not just making widgets anymore. The new economy is very online and very tech based. And that seems to be driving us a little bit now. And a lot of people are saying, hey, this is actually what's going to save the US economy is this productivity driven, boom in the tech industry that's going to just, take care of everything.
Yeah, but I think that's a little hopium. It's going to take time.
Is it going to come fast enough? I mean, think of it this way. 10 years ago, which was like 230 or 40 years into the existence of this country, our national debt was $17 trillion. 10 years later, we're double that. We took 240 years to get to 17 trillion. And then we took 10 more years to double that to 34 trillion. And we're likely going to be I read Congressional Budget Office is estimating 48 trillion by the end of this decade. So another 14 trillion. So basically doubling it again almost just in the next 6 years. And so, yeah, productivity is certainly going to help. But without other measures, that's not going to save us. And I know we've talked about the law of unintended consequences on this podcast a good bit over the last few months. But here's another example of that, and this is something that I found kind of hidden in a Powell speech or in a Fed release from a couple days ago. We talked last week about the fact that one of the reasons we could avoid raising interest rates again is because we're doing the other thing that will slow the economy down, which is the Fed is kind of rolling assets off its balance sheet. It's reducing the money supply. Well, it turns out that because of this bond thing that I was mentioning a few minutes ago, the fact that these treasury auctions aren't getting a lot of demand for bonds, the treasury is a little concerned that if they have to sell too many bonds, it's going to break things. So in order to not have to sell as many bonds over the next several months, what they've decided is instead of rolling off $60 billion worth of bonds from the Fed's balance sheet every month, they're going to ratchet that back to $30 billion in bonds every month. So this is the unintended consequence of, in order to not break treasury bond sales, we're potentially risking higher inflation because we're not reducing the money supply or slowing down the growth of the money supply nearly as quickly. And so, yeah, and who knows how many other things are going to happen that we can't predict. Like what's A is going to affect B, is going to affect C, is going to affect D, and we just can't predict all the impact down the road. And so, yeah, I'm a little concerned.
Well, and Powell talked about it. He said, at the end of the day, he's like, we need the labor market to come down. He mentioned it again. That's how he ended. He's like, unless there's changes in the labor market, you have to kill aggregate demand. It doesn't.
There have been. We already talked about that too. Like the number of people with multiple jobs is at an all-time high. The part-time jobs is, I don't know if it's all-time high, but it's way up there. They just did a survey last week of small businesses, and small businesses, the sentiment of over hiring is like just plummeted, fell off a cliff, which is a very good indicator of leading job losses. So like there is indications that is happening, but if you look historically, job losses don't usually happen until after the Fed is already cutting. So like the fact that Powell is using that as a leading indicator of when to cut, it's never happened before. It's never been, oh, we're seeing job losses now, we cut. So I don't see how that's going to happen this time around.
Part of the problem is the data that they're using. And I know these are smart guys, they're economists and they've been bankers and all of these
$150,000, by the way, Anna. We said that last episode. That's how much they make, the statisticians for the government.
Yeah, not as much, right? But a lot of the data that they're looking at, like even inflation data, I've been really trying to dig underneath the hood into GDP and into CPI and the inflation data to see where is the strength and where is the weakness in the economy. And, you look at CPI and, 35% of it's housing. And they say housing's up 5.6%. That data alone doesn't account for the fact that 2/3 of people own their home and aren't impacted by these inflation rates, right? So they're not impacted by the higher, cost of rent or rent equivalent. And so even that piece of housing costs can skew inflation to the upside and make it look like it's worse than it is. But there's other numbers.
Well, and we already went through, it's a fake number too, right? Like the owner's equivalent rent, like it's a fake number.
It's a fake number. Absolutely. And then the other thing is but there's similar issues on employment. And, this is why we have all these negative revisions where every, month, the prior month is shown to actually be worse when it comes to a lot of these numbers, showing that the economy is not nearly as strong and overheated right now as many think it is. But then there's other numbers that seem to show something different. So you look at super core CPI. So, the Fed likes to strip out housing to say, how is the rest of CPI going. And for a while, when energy prices were down, goods CPI was really coming down. And that gave everybody the hope that since goods are coming down, housing's kind of not real numbers, we'll be okay. Services inflation was high. Well, supercore inflation's this last print over a 3-month period was an 8.8% inflation rate annualized. So supercore strips out housing, food, and commodities. So basically, it's looking at your goods, and that is up significantly even before these potential oil shocks. And so
I think we also act like, though, like when we're stripping out oil, like we're stripping out the effects of oil, like everything uses oil. Like when you just said goods, like how do you think the goods get to us? Like they need oil.
Right. And so if oil's not even up really high yet, and it was already at an 8.8 print, it tells you that goods are continuing to go up in price while companies are still trying to push profits. And if there's oil shocks, that's going to go high, even though housing inflation may actually start coming down. And so it's very difficult when the Fed is using numbers that don't tell the whole story. And when the reality is most of the economy, I mean, the bottom 80% is the ones living check to check. What are they spending money on? Not the super core with everything stripped out, but the insurance and the food and, their
hopefully the rent at their apartment.
Their rent. And so, basically you've got an economy where it's very bifurcated, and just like the stock market is rallied by the Magnificent Seven, when many other corporations have negative, profit prints, you have 80% of the economy struggling, and the top 20% is keeping it going. And then similarly, when you look at GDP, the first quarter, the first month that the GDP came out for the last quarter, it was like so exciting. The economy is booming. Everybody says the economy is really healthy because we had a good GDP print. But the vast majority of that GDP was produced by the government sector, not by the private sector. And so
government and healthcare, right? Like
government and healthcare. So we have kind of this almost like a rolling recession. We don't have clean definitions. We're not in a recession technically. We're kind of in a rolling recession and stagnating economy where we have one sector at a time just barely producing enough production to make it look like the economy as a whole has a good enough GDP. But the reality is, I think we're in something much more like stagflation, where we have a very stagnating economy, a very stagnating Main Street, not Wall Street. That's a different story. There's a real disconnect there. But at the same time that we still have some persistent inflation, but we don't really know what that real inflation number is because it's so bifurcated. So I think we have more of a stagnation. I'm hoping we have a formal recession declared, and that the Fed will cut rates, and maybe that will actually help with some housing costs of equivalent rent, because some lower rates could help in certain areas, especially the debt service costs. But it's really difficult to know the timing of when these things are going to happen because the economy's so bifurcated. The data is not good. It is lagging, and the Fed is looking at lagging indicators rather than strong leading indicator data.
So I think the Fed actually doesn't. I think what the Fed tells us they look at isn't yes, they look at it, but that is not how they base decisions. You're talking about the people that have the most economic data in the world. They don't come out and say, well, I saw that the CPI on CNBC was this, and so we're going to do this, right? Now, they say one sentence on the decision that they made. But that is not how the Fed is gathering all their information and data from each of the central banks, right, and looking at it. And I think that their motives, too, they're beyond not clear about. It's such a false little thing. We're not going to talk about much. We're not going to say much. I think they're looking at soaring asset prices. They're looking at the housing market overall and the problems that we're having there. And they're really looking at Main Street. And they're saying we have the Main Street right now is so much worse off than they were 3 years ago. And you have these political pundits and you have these like newspapers. They're like, no, everything's great. Everything's going good. And Main Street's sitting here going, what? Like we're dying here. We're like, and that's the Fed's looking at those things saying, I got to make a decision. Who am I helping and who am I hurting here? And you're right, because it's two different worlds. So they're picking who they're going to help and who they're going to hurt. And they can't say that, right? They can't come out and say that. So they're going to point to a few things, but they are really deciding here, who are we going to hurt? And that's what they're doing. And they're not transparent about it. We don't really know the input they're looking at.
Well, because they're not getting helped out, right? Like nothing that has come out is helping the Fed's decisions. Like we talked about jobs. Like if we had some bad jobs, or if we had the stock market like have a correction or something like that, that would help them out. That would decrease demand. People would feel like, oh, maybe we do have a recession, and that would give them a little bit of cover. But none of that has happened.
We need bankruptcies. We need the credit, but we need the money supply to shrink.
Like I agree with you, AJ, that the Fed is absolutely picking winners and losers. But I want to go a step further, and it could be even worse than that, and even sadder than that. So I was reading an article this morning, and it was in Bloomberg, and apparently it was talking about this not so much talked about idea from modern monetary theory, MMT. And please nobody in the comments start arguing with me about MMT or Common Core math or anything else that you hate just based on dogma. I'm not saying I agree with MMT, but this is actually an interesting theory. And it's been around for a while, but it just kind of resurfaced a few months ago. But the theory basically goes that if the Fed raises rates very quickly, one of the, again, unintended consequences of that, obviously you're trying to quash inflation, you're trying to kill demand, kill growth. But one of the unintended consequences is that you're taking all of these people that are super wealthy. What do super wealthy people own? They own bonds. They own a lot of bonds. And when you hike rates really quickly, what you're doing is you're generating a lot of return for a lot of really wealthy people through their bonds and through their savings accounts and money markets accounts and CDs. And suddenly they've got billions or even trillions of dollars of free cash flow because you've raised rates, which goes against conventional wisdom, which is you raise rates to make it so nobody has any money. But the people that are wealthy have a lot more money when you raise rates. And if they decide to not reinvest that money, if they decide to spend that money, well, that itself can spur growth and inflation. And so there are some people out there that believe, and again, I'm not smart enough to say they're wrong, but there are people out there that believe that the fact that the Fed raised rates 500 basis points in a year actually led to some of the growth or a lot of the growth in inflation that we're seeing today. And if that's the case, I mean, talk about unintended consequences. If we don't understand the mechanisms of the economy that like raising rates 5 points is actually going to spur growth and inflation, what else don't we know?
Well, here's where, the question of how smart are they and what do they know and what's on purpose versus what do they don't know. I think that they have theory on paper and they have models and they talk about their models. And I've listened to a lot of ex-Fed governors and Fed, people that were the head of different area Feds, like the Dallas Fed, for example. And, they will tell you that essentially we have our models. We generally have two schools of ideas, either Keynesian economics or more the modern monetary theorists. And most of those that are in control globally of the central banks are more on the MMT theory, where they just have thought we can print lots and lots of money, we can kick debt down the road, and it's never going to cause inflation. And what's happened is that their models haven't been correct, and they're finding that it is causing inflation. And so I think some of it is they really thought that, and I think part of it's because we were on such a deflationary path for 40 years, and it was hard to get inflation to where they wanted it to be, because they want a little bit of inflation because the government likes to pay down debt with cheaper money in the future. And so why isn't inflation 0? Their target was 2 because they want just enough inflation to be able to pay down, debt and get GDP just a little bit above that so that you've got some type of real return. So I don't know that it was all intentional, but I think that the Fed knows, they know, one, they're dealing with big problems at the fiscal level. So again, coming back to this fiscal level, while they want to stop asset bubbles from happening, which is what's happened when we've had really cheap interest rates, and if they cut rates again, And I think they're only going to do it if we're in a deep recession or we have a banking crisis. And I think if we're in a deep recession or a banking crisis, they will have to pivot off of inflation. They'll say, we see the path down to 2%, so we're going to pivot, we're going to help the system. But in order to help the system and cut rates to help the Fed pay for all this inflation and all of our debt, that is going to create asset bubbles again. And it's going to create wealth, us that have money and have been sitting on the sidelines, the top 20% or 10% that own 80% of assets and have 80% of the cash, we're going to go spend it. It's going to create more asset bubbles. But I think the Fed doesn't have a choice because they have to get the fiscal spending and our fiscal debt under control, and they have to rescue us from a recession. So I think in the short term, even if inflation is persistent and these numbers are higher than what we want to see, at some point it's going to break. They're going to have to drastically cut rates, and then they're just going to live with the asset bubbles, and we're going to have to reset our inflation expectations. I think inflation can't go back to 2.
It's not a bad thing for the government when you look at it with low rates and high inflation. Like the government kind of wants that in order to be able to pay off their debt.
But they can't tell you that, Kyle, because if they say you're 80% of the country, you're hurting, your food costs 25% more today than it used to, but we're going to let inflation stay higher. They're never going to admit to that because everybody would riot. There'd be riots on the street.
Well, they at least can't say it for the next 6 months. Like they're gonna do everything they can for the next 6 months to not rock the boat. But then, I guess maybe if we get a new administration, I don't know. It's pretty much a toss up right now. I don't know if that changes anything.
I don't know that it does. And there's a book, I don't know if you've read it, but it's called Principles for Dealing with Big Debt Cycles by Ray Dalio. And he goes into hundreds of years of studies of every country that's had what we would call equivalent to the world reserve currency and what happens and why do countries fall that have been the dominant currency power, but the dominant global monetary power. And it's essentially once you get to so much debt that you can't tax your people enough, there's only 3 solutions. And we're already there. We're way past the debt to per capita.
Well, it's basically going to take one more war, right? War spending is usually what pushes people over the edge.
But eventually that creates GDP, and it creates, wars are actually good for a country's GDP. It's bad for their debt, but they put people to work to create bullets and all kinds of things. So sometimes countries that are in trouble are accused of creating war just to stimulate their economy. But in the short term, it creates more debt. But again, he says that there's only 3 things governments can do. And he believes we're at that phase now. It's either raise taxes significantly, which I think either party's going to have to do after the election. Don't shoot me because I'm saying raise taxes, but there isn't much choice but to raise taxes. It's austerity, which means you cut social programs. All the calls for, cutting Social Security benefits, raising the retirement age. Every country's having to talk about doing that because we simply don't have enough money and can't tax people enough to pay for it. So it's austerity, cutting expenses, it's raising taxes, or it's allowing inflation to happen without telling people that you're devaluing their money, because inflation allows the government to pay down their debt with cheaper money. So they're never going to tell you we're going to make our new inflation target higher. Their hope is that they can get the federal government to cut spending. They can get the federal government to raise taxes so that they can allow inflation to come down, and then that the government spending will create enough GDP through all those things we talked about, AI, reshoring, energy independence, that they'll create enough GDP to just barely be above the new higher inflation where we can eventually get out of the debt problem and grow. But that's going to take a decade. But they'll never say that, but they know that.
Well, and 2, that's discounting that there's no social upheaval, that you don't have the people then don't turn. I mean, you have high inflation, you start raising taxes, and you cut Social Security. In America, you burn the country down. That's what happens in America.
And that's the next thing that happens is the internal conflicts,
Let me just say that this is the reason why I wanted Anna on this show. We've been talking about the same topic for a year now, and I think the insights just in the last couple minutes kind of dwarf the stuff we've been talking about for months. Let me throw out one more thing. So we often talk about what's going on in this country, and we look at things kind of through a lens of we're Americans, this is America, we care about our economy, and we need to control our economy. But it's important that we always remember that we live in a global economy these days. And everything that happens to us is relative, and everything that happens to everybody else is relative to what's happening to everybody around us. And so as bad as things are in the U.S., if we look around the world, and I'm not saying this makes things better here, this could be a bad sign, but we're actually in a better position than a lot of places. We're seeing lower inflation than a lot of countries. We're seeing less money printing than a lot of countries. I mean, one nice thing when we talk about our bond issues that we're having here that we talked about earlier, investors can't get a better return anywhere in the world, or at least a risk-free return anywhere in the
I
world.
was going to say, you could go to Argentina.
A risk-free return.
I don't know if you saw their bond prices the other day, but
you can't get a better risk-free return than U.S. Bonds right now. That 4 or 5% is pretty attractive to big investors. Not to mention countries like Japan and countries that use the euro, the eurozone. Right now, they have trade surpluses, which means they're getting a lot of U.S. dollar-denominated capital into their countries. What are they going to do with it? They're not going to invest it in their own bonds because they're paying 0 or 1 or 2%. They're moving that money back over to the U.S. And so there's a lot of reasons to believe that all of the bad things that are going on in the world, while it's obviously causing chaos and turmoil here, maybe one of the things that's going to save us longer term. There's going to be a lot of money flowing into U.S. treasuries over the next couple of years because a lot of these other countries that have, again, U.S. denominated currency are going to need a place to invest and a place to put their own currency reserves. So, I mean, that's just another way to look at it, that yeah, things are bad, but they're not as bad for us as they are in other places. And it could be bad for the world, but it could be good for us.
Yeah, as far as first world nations go, our debt to GDP is actually not that bad, which is shocking considering of how much it's increased, how much we are increasing.
But how far can we push it before people lose faith in that all of a sudden those bonds aren't as attractive as they used to be?
Yep.
Well, and that's gonna be to Jay's point. I think, where are we compared to the bonds of other countries? And as long as we are kind of leading the charge and we have that reserve currency, it does allow us to continue printing for a while. People have been sounding the alarm about our rising debt for years and thought we would have a treasury crisis sooner. They're the ones that were very much against MMT. And then the MMT guys are saying, no, we can do this for a little bit longer. So I do think as long as we have the world reserve currency, we're in a much better position to get ourselves out of a stagflationary environment than other countries would be. But if we were to start losing that status, which is a topic of debate by many as to when could that happen and is it likely that it would, countries that don't have the ability to continue to print like a world reserve currency that is still attractive to other central banks to hold our treasuries, for example, hold our dollars or other people to buy treasuries. If you lost world reserve status, you'd go down a lot faster. But having that definitely helps the United States to where I have hope in the long term. In the next couple of years, I don't have a lot of hope that it's going to get good. I just think we're in for a lot of pain. I think that over time, as the government, starts to put money into production, that we have a way out, to kind of deleverage our debt without going into a serious global crisis or an inflationary crisis. But if we weren't the U.S. with a world reserve currency, I think we'd be in a lot worse shape than what we might be, Jay.
And this is the other side. This is the other side of that coin, where people talk about, the Fed has destroyed this country and devalued our currency, and we should be back on the gold standard. And the reality is, there are reasons to argue why the gold standard was good, but the reality is, had we been on the gold standard during the Great Depression, or let's talk about World War II. The Allied forces would not have won World War II. We would have not had enough money to have fought that war. We were able to print our way out of that war. Likewise in 2008, likewise in 2020 during COVID, there's no way we would have survived as a nation if all we were doing was surviving on our gold reserves. And so, again, printing money, I'm not saying it's a good thing long term. I'm not saying it doesn't have risks, including catastrophic risks to our entire economy and our entire nation. But there's some upside to being the world reserve currency and having the ability to print fiat when you need to.
Speaking of World War II, why don't we talk about World War III? Well, if you believe the memes online, then we're heading towards World War III. And if you were living under a rock, then you wouldn't know that over the weekend, Iran retaliated for Israel's bombing of their embassy in Syria that killed 7 Iranian officials. And it did so in spectacular fashion, launching over 300 drones and missiles towards Israel. Now, we're incredibly lucky to be Americans, and we don't have to deal directly with any of these conflicts overseas, but we do need to consider that they have effects on us as investors. And one of those major effects we already talked about is the price of oil. And with it being Iran, it's always, whenever there's something going on with Iran, it's always talks of oil. So AJ, what does the future of oil look like, and how is that affecting our economy?
So, oil is always a really big topic for a lot of reasons. And it's not just the fact that it's gas or even that it's the cost of production. Currency and how our markets actually work are very tied to oil. So a lot of people think that it's just a production thing, everything else, but that it's not that alone. How Wall Street works, how money and transactions work, are very tied to oil. It's a very important thing in the world economy. Outside the actual gas and the actual energy part of it. And so what happens when oil prices go up and down, it can also change asset prices. It can change the overall leverage points that we can use, but it changes the cost of production, and it changes obviously how Main Street gets hit. So when Main Street is affected largely by 3 main things: food, housing, and gas. That's it in America. That's really it, right? Food, housing, and gas are the things that break us. Those are the things that end the economy. If you can't have food and you can't afford food, you're starving. If you can't afford house, you don't have shelter. If you can't afford gas in America, you can't work, you can't do anything. So when Americans are super sensitive to gas prices. Now, as we've seen with what's going on in the Middle East and Iran, that makes oil prices go up. So oil prices have been going up over the last week. And the interesting thing to know, though, is last year, OPEC actually decreased their barrels. So they made decisions because economic slowdown was coming. So over a year ago, they already were decreasing their output. So they were decreasing their output to try to stay ahead of the economic slowdown, which was working. And that was working fine. But the Middle East, as you start to run into problems, that affects OPEC. That affects how much can be shipped. That affects refineries. 2, we also have Russia, and Russia is also at war. So we have the major suppliers for the world's oil right now that are at threat or at risk. So a shock to the system and the cost of oil is very likely at this point, hence the reason why oil prices are rising so fast. Now, they haven't reached $100 a barrel, but they're up at 85. I mean, they've gone up from 70 to almost 90 in a week. And the odds of it, if the escalation happens, will be at $100 a barrel quickly, very, very quickly. $100 a barrel in America, that's a problem. And it's even worse when you have inflation like we have. So when we should have been replacing our strategic reserves, we weren't. And so we have no reserves left, really. So we can't even do anything about it. That's right. The Obama administration wanted to lower the impact of the gas prices in 2023, and they started releasing our reserves because the gas prices were hurting Main Street. So they started releasing reserves.
Definitely Obama's fault.
Thanks, Obama.
Obama. Blame Obama, everybody. So Obama told Biden to do it. So that reduced it. What that means, though, is we don't have anything to really fight against it, meaning that now if we do have an oil shock, we're stuck, right? We get what we get. Now, we have been able to produce way more in the last oil. America, we have lots of oil, right? we don't access it all. But fracking revolutionized oil. It dropped oil prices down. We can produce and we have lots of oil, but it's not a light switch. It's not something you can turn on.
And fracking's what? Like it's the break even's like 60, right? 60. Am I getting that right? $60 a barrel?
Yeah. Break even's like $60 a barrel. So as oil prices rise.
Yeah, and let's be clear. The U.S. exported more oil last year and pulled more oil out of the ground last year than any nation on the planet. So
by a lot.
Yeah, by a lot. And so we do have it, and there are regulatory and legislation and executive issues around that, but we've got it if we want it.
We've got it, and we got untapped oil. We have so much oil, it's crazy. That we haven't even touched. With that said, though, you can't just it's not like we're just like, all right, well, pull it out of the ground and we'll drop oil prices. So what happens is as oil prices rise, it goes to above $100 a barrel. Then oil production ramps up in the United States because now we can make lots of money.
Well, and there's a lot of talks too that $100 barrier, that's where OPEC's going to all of a sudden ramp their production up again too. So like that, it's theory. You never really know what OPEC's going to do. They're kind of a wild card, but they do control a lot of it.
Kyle, let me ask you this about OPEC. So I was a little bit worried about this, just even after, Russia and Ukraine continue to go on, but especially after Hamas attacked Israel and now with Iran in the 70s, what happened was essentially it was also Israel. It was, the 50 year ago war. I think it was October 6, 1973. But because the U.S. went in to defend Israel, OPEC, which at the time was led primarily, it was Middle Eastern countries, but Saudi at the time was against Israel. So they got together, the Middle Eastern countries, and raised oil prices 70% in the 2 or 3 days that the U.S. said we're coming to Israel's defense. So I was afraid that the same thing could happen. But I know that OPEC, I think, is primarily run by the Saudis, who are on Israel's side this time. They helped the U.S. to defend Israel from these Iranian missiles. So I don't know a lot about OPEC and how interconnected these Middle Eastern countries are. So I don't know if any of you guys know.
It was really interesting too. Like all those countries like Saudi, when Iran did the attack, like they came out and they didn't even really condemn it. They came out and basically said, we hope cooler heads prevail. We hope that there's no retaliatory strikes. We hope that this is like the end of it. Like the Western countries all came out and said, we strongly condemn, the attacks on Israel. And the
part of that though is the difference between the Sunni and the Shiite Muslims. I know we don't want to go too far into that right now, but essentially, Saudi entered the Abrahamic Accords to have peace with Israel. And Iran doesn't want that. Iran wants to wipe Israel off the face of the planet. So the part of the reason Hamas, which is basically a proxy for Iran, attacked Israel is because they were about to expand the Abrahamic Accords and more Middle Eastern countries decide to have peace and natural trade with Israel. Iran doesn't want that. So Iran is trying to keep that from happening and create tension so that whole area and the whole region of Middle Eastern countries do not cooperate and have peace and free trade with Israel. So the question when it comes to oil is, how much is Iran involved with the Saudis and OPEC in setting oil prices? I don't know the answer to that. I know it's primarily been Saudi, that would be good for oil prices because they would be incentivized to help Israel and America not let oil prices go crazy during America's inflation. But if it was Iran, they'd love to jack up oil prices, make it harder for the U.S. to be able to fund.
And a lot
Israel.
of people forget, like technically Iran is under sanctions from the U.S. And I say technically because like they were like the sanctions are supposed to be oil sanctions, like bring them down like below 1 million barrels of oil a day. But like because of everything going on with oil prices, the U.S. is kind of just like not enforcing it, right? Like all of this Iranian oil is getting shipped to China, and anything that's on a Chinese ship, the U.S. is just letting go. And so like if you look at it, like Iran's still pumping out 3 million or more barrels a day. And so like they have this kind of delicate balance where like the U.S. obviously knows, but like they don't want to rock the boat, if you want to be a little bit literal.
Does Iran impact OPEC's decisions?
I think to say they can't is an understatement, but they don't have the power they used to. And one of the reasons being is because of not only obviously what you mentioned, the politics and OPEC stuff, but honestly, OPEC was way more powerful 20 years ago than they are today. So OPEC produces about 40% of the global supply of oil, right? But the fracking revolution in America, that really hurt OPEC, because it was a way that America all of a sudden could say, we'll just increase our production. So we could essentially, after that occurred, we could affect global prices. Prior to that, though, because of all the oil that we'd shut down in America, we couldn't. We had lost a lot of control.
Well, that's why OPEC, how many years ago was it that they tried to crush fracking, right? They're like, okay, well, fracking, it costs $60 a barrel. We're going to bring it down to 40. See how long it can last.
Yep, exactly. That's exactly right. And so that really disrupted the global balance of oil, right? And so OPEC has to play more than they've ever had to play. They can't get away with what they could have 20, 30 years ago. And it's just a reality, because we can start shipping oil to our competitors or their competitors. Right?
Well, and how is this black market affecting it too? Because we could talk about OPEC and we could talk about like above board transactions, but right now we have Russia, we have Iran that we just talked about, who are basically they're dealing like below the table to, like, you know, Russia's oil still getting out there. Like, even though they're sanctioned, like China's still buying it. Like they're at discounts, right? Like they're getting discounts because it's not going through like the normal channels. So like, how much is that affecting what OPEC's using as decisions?
And it is. And that's why that control factor has been disrupted. So they can't just say, we're going to spike, or we're going to drop oil costs, or we're going to spike it, because everybody, there's more players on the field, right? So they've really got a lot of that disrupted. And you could see that in what's happening in today's environment, where OPEC, I think, could have been a lot stronger arm. Now, politically speaking, I don't think that they would, because of the Saudis, but no matter how you look at it, it's not like it was. But the OPEC is still going to be affected by what's obviously happening, because global oil trade will be affected by this region, not just by the players, but the actual shipping, transporting, and refining of the product. So it is not just a political structure over there with OPEC, and it's actually a logistical thing. So once you start tipping the odds or the balance in some of these countries due to war on not only how much oil can be brought out, but how much can be refined, and then you start messing with the Gaza Strip, or the what's called sea, and you start messing with the transport, which that's what they were doing. They were trying to affect trade. That all starts to get out of whack, and oil can just go crazy very, very quickly. And that is one of the leading things that the United States has done to stabilize the world, was they stabilized oil trade with their Navy. So a lot of people don't realize that, but the number one reason oil prices are where they are is due to the stabilization of the shipping and refining of oil. It's not just pulling it out of the ground.
We basically take care of the Strait of Hormuz, like our Navy.
What about it? Our Navy?
Like our Navy basically takes care of the Strait of Hormuz, like that major strait there.
Yeah. That's why when they shot a British ship, right? It's the running joke in America, you don't touch their ships, right? Japan touched our ships, and you don't touch the ships, because that's our thing, right? You touch our ships, we're going to blow you to the moon. And so it's a big deal.
A little bit of context and backstory here to give some clarity on what AJ is saying. Basically, the price of oil is driven by four things. Obviously, supply and demand in all of those things is what drives it, or most of those things is what drives it. But there are four main components of the price of oil. Number one is how much is getting pumped out of the ground. And so that's about 55% of the cost. And so you look at OPEC right now, and it's interesting that in the spring, they typically scale back on pumping oil out of the ground. The fact that we've seen oil prices rise in April up until the whole war stuff last week wasn't a surprise. We typically see prices go up in April because OPEC scales back for a month leading into the summer. I've heard, and I don't know if this is true, I've heard they actually like clean the refineries or something in April, and so they purposely scale back. And so if OPEC wanted to, they could be generating an extra 6 billion barrels a day. So they could, if they wanted to drive prices down, they have the ability to drive to crash prices, because again, that's 55% of the cost, and they can be producing millions of barrels more. Likewise, they could say, hey, we're producing less and drive the price up. So they have a lot of control there.
But then America would also say, we're not going to protect the shipping lanes.
100%. And then number two, the second biggest is about 20%, 15 to 20% is the refinery cost. So they take that crude oil, pump it out of the ground, they have to turn it into gasoline. And so they have factories that turn it into gasoline. That's about 15 or 20%. Another 12.5% is distribution costs. So basically getting it from here to there. And that's what AJ was saying. And Kyle was saying, how you need to be able to safely get oil around the world. If there's risk to being able to transport oil, that increases the prices tremendously. And the fact that contributes.
Well, and it's not just the cost of the pricing, that 12%, because what happens is you can't get the oil to the refinery. So then you screw all the supply and demand. All of a sudden, you have a mass shortage in supply because it's not being refined. So it's not even the 12% that matters. It's that all the ships stop. And all of a sudden you have a crash in supply. Nobody can get oil anymore. And that's where the shock comes in.
So AJ, let me ask you this, because one of my thesis about inflation, us having a much higher inflationary decade going forward than what we've had in the past before this recent inflationary shock, was because of everything that happened with COVID and then with Russia and Ukraine, and now with Israel in the Middle East, is that I see the U.S., at least this is what my thought process has been, trying to bring back more energy independence, actually tap and refine and use our oil here as a matter of not only economic security and supply, protecting us from supply shocks with all these third party global wars and rumors of war, but also as a matter of national security. So the question is that a good thesis? What would have to happen with the way things work with trade and shipping and OPEC today in order for us to become truly energy dependent? And would that be very inflationary and have a strong cost over the next decade to get us to that point that we are energy independent?
The issue isn't that it's inflationary. If anything, it's just the opposite. The problem with that is, and I hate the word energy independent, because as long as we're producing more oil than we're using, we could allocate that in the U.S. So we are energy independent.
And we did in 2023. We produced more than we used.
And we have been since Trump. So since Trump through now, we've been energy independent. So it's the last two administrations. But here's the issue. If we're going to pump crude out of the ground, we're going to refine it, we're going to distribute it, we're going to market it, we're going to tack local, state, and federal taxes on it, and we're going to sell that to Americans. Are we going to charge them a lot? Or are we going to charge them a little? We're probably going to want to charge them a relatively little amount compared to what we'd be paying to get it somewhere else. Otherwise, Americans are going to complain. But if we do that same thing, we pump it, we refine it, we distribute it, we tax it, and we send it somewhere else, they're going to pay market price for it. And so we make a whole lot more money selling our oil overseas than we would if we pumped it out and we sold it to Americans. So it's not like we couldn't do that. But oil companies don't want to do it because they're going to see lower profits. The government doesn't want to do it because they're going to take a lot of flack from Americans for high prices when we're consuming our own oil. And Americans don't want it. Well, actually, Americans would want it, but Americans don't have any say.
So you think we have enough that there would be excess supply and there would be cheap enough production that it would sell cheap and bring the cost of oil down?
But the problem is the cost of production for America is double what it is for OPEC. They have sand, right? It is so cheap for them to get it out of the ground. It's just spewing out. In America, it is not cheap for us to get the oil out. So the problem America has.
Yeah, that's what we talked about before when they tanked the oil prices because their cost was so much lower than ours, and they wanted to drive our oil industry out of business.
And so that's exactly right. So if we say we're going to be totally this, we would literally have to tell Americans, you can get oil if you bought it from them for $30 a barrel. But if you're going to buy it from us, you have to pay $80 because we can't make money if you don't. People are going to go, wait, you're telling me I have to pay 3x the time, right? Because they can produce it cheaper. And OPEC can do that. And that's why the balance actually exists. Because yes, we do have all the oil, but we cannot produce it as cheap as they can. Their cost of production is shockingly low. For us to pull a barrel out of the ground, it's 3 times what it is, at least, their cost. So we always have that in the back pocket where they come in and say, we will supply and we can do it. So not oil is all the same, by the way. Not oil is the same. We have different types of oil. So it is a complex system, right, that works. And it's been a balancing act that the United States stabilized. That is like the thing that the United States did. We're known for it, right? You got oil, we're coming over there, right? Because we stabilized oil markets, energy markets. We dropped the cost of production, everything down. And everybody understands to a degree that this works. So all of a sudden, the Middle East plays with us and we play with them. The oil companies, they play in between everybody. Now, that's not all controllable when the Middle East goes to war. And then all of this gets shocked and dispersed. And then moms go to fill up their minivan and it costs them $5 a gallon. And the American economy starts to tank. All of a sudden, the Chinese production to run their facilities, to transport and everything starts ramping way up. And the cost of goods and services go up. And all of a sudden, you get into a place where this one thing tanks everything else. So this is why we go to war over it.
Is $100 that level? Is that where we see the problem, or is it
typically once you go over $100? That's when you start to see social issues, because it gets into, though, I don't think it takes $100 now, because the problem is all other goods and services have inflated so much that inflation's not the same that it was 3 years ago. If you have 5% inflation today, it's on the back of inflation that has been 9% year over year over year. So a small amount of inflation today, we feel it way more than we did 3 years ago. So you have oil.
And that's where that 8.8 super core annualized over the last 3 months, that's for goods. If oil goes up, that 8.8 will go up over the next couple of months. And that could keep the Fed from saying we're cutting interest rates at all.
And this is why oil could be the thing that literally breaks us. It could be the thing that Americans are like, we can't take anymore. We can't spend. We're cutting back. All of a sudden, production, everything else. And it becomes like sugar in the engine. It clogs everything up and gunks it up. And the economy just stops working like it had normally. And this is a big, big issue when you're at a point like we are. So with inflation, with interest rates where they are at, with the economy and Main Street struggling, our economy runs on cheap gas. And if that goes out, you kind of took out the one thing that Americans had.
I guess the solace that I take is I have hope that nothing's going to happen. I mean, I look at this Iran attack, and obviously over the weekend, it was crazy. Like everyone, as I said, World War III memes going off, like, and then when you break it down, like it kind of seemed more like a symbolic attack. Now, the problem is that we have Netanyahu in Israel, who the guy's a bit of a wild card, to say the least. You never really know what he's going to do. And apparently, the news is coming out now that their war chiefs, which I always thought was a funny name, war chief, in the modern day, but their war chiefs are split on what we're supposed to do. But like, I still think it seems like enough people are saying, hey, cooler heads. The U.S. has already kind of been pushing Israel, saying, hey, you're like, there's a few things you're going too far. We're getting to the point like we can't support some of the stuff that you're doing. And they've come out and said, don't retaliate on this. And so I guess I just have hope that, maybe Israel's going to respond, but maybe it's going to be like a cyber attack, I've heard, or like something that is a little less significant, that we're not going to see that full scale war. And that, because it seems like everybody wants to kind of just keep the oil flowing.
Well, I take solace in the size of our bombs and military. So that's a coarse thing to say, but it's true. It's the reason why America is so pushy and invades over oil.
Well, and Israel doesn't want to jeopardize our relationship, I assume. Like we give like one of the most amounts of aid to Israel of like any country. So like they don't want to jeopardize that. And we've been I feel like the relationship has been straining a little bit over the course of the war and some of the stuff they've been doing. I don't want to get political on what I agree with and what I don't agree with Israel doing in the war, but it seems like it's been straining, and it's almost calculated in the way that Iran kind of did enough to like make their point, but like not enough for for the US to say, oh, you should strike back. And where Israel, if they did something, I feel like that would strain the relationship even more. So I guess I just have hope that this is going to be, and the markets agree too. Like if you look at the markets, like this should have moved the markets a lot more, and everyone kind of treated it more like a nothing burger. And so that I mean, all of that combined kind of gives me a little bit of hope.
I think for me, Kyle, when I look at these kind of things, I feel like the last decade or so, we've been kind of spoiled with relative peace. Yes, there's been, there's been issues. I mean, we've had wars, we've had Afghanistan, et cetera, but the US economy just kind of kept going. And there was a lot of global cooperation. What worries me a little bit, and I think there's ways to hedge against it, which is where I'm really focused right now on hedging all these exogenous shocks. Like, okay, if the economy goes back to somewhat normal and we get out of let's say we have a recession and we're back out of it and we have production happening, what are the things that could, what are the big hairy monsters, the next black swan events, and how much of our investable dollars and how much stock do we put in the probabilities that things are going to happen externally? What makes me a little bit nervous is that you have these leaders that have risen up that are not as prevailing heads. You've got Putin, who wants to basically not allow Ukraine to join NATO, which was what this was all about. They want power and they don't want them to join NATO. You've got, Hamas and Iran not wanting Israel to have peace with Saudis and trade and have these peace accords. And then you've got China kind of coming in and being a little bit more militaristic. And so the question is, do we ever go back to a globalized world, or is that era kind of over and moving back to a deglobalization or regional partnerships that kind of reframe how things happen going forward? And then what's the economic impact of that? So for me, I just feel like a lot of these things are very inflationary. I just try to think simplistically, like break it down. Are these things going to be depressionary, or are they going to be inflationary? And then what do we do with our assets? How do we predict where interest rates are going to go so that we know what is a fair risk premium and what we're investing in, whether it be multifamily or whether it be, bonds and US Treasury rates? So I tend to think all these things are going to cause more pain and more inflation, kind of bringing it back to that inflation, until we get to a place where there really is stability globally, peace and cooperation globally. And so, I'm thinking about things like, how much money do we now set aside to hedge the things that we do for a living, like keeping our main thing the main thing, right? We do real estate, and inflation generally is good for real estate unless you're in commercial and you have variable debt that needs interest rates to stay low. So, aside from that, asset values tend to go up in inflation. So how are y'all positioning yourselves to kind of hedge either a more inflationary or less inflationary environment, and an environment that might have more volatility coming, and kind of volatility and risk being the new norm rather than the black swan? What are y'all thinking about that?
I have all my gold buried in Jay's backyard.
I put my gold in Jay's backyard too.
I do too. I need to go. I'll see you guys later.
Jay grabs a shovel.
Well, no, but like we make jokes about that, but it is good to like. I feel like there will be opportunity. So putting money in things that you could say treasuries, but like assets that are a little bit protected by inflation, but also you have that ability to take advantage of an opportunity that comes along. So gold is a decent one with that. Or insurance, even overfunded life insurance policies. My wife and I have those as well. As you said, we're pretty heavy in real estate still. Different asset classes over different areas, because as you said, like you can't, if you just all of a sudden bought every apartment complex that came along with variable debt and bridge loan, then you'd be feeling a little bit hurt right now. But in general, like even a correction in real estate, like it's, you don't lose your shirt. So it's as far as we have nothing, we took everything out of the stock market kind of in 2019. I look dumb now.
I did the same thing, Kyle, but I made a lot of money in real estate, so I don't feel bad.
True, but I keep thinking it's going to go down. Like we're like, it just doesn't make sense to me. Like we're like what, over 20 price earnings ratio right now. So like if you want to compare that, like you get technically better earnings in bonds. So yeah, so that doesn't make a lot of sense to me. But I don't know about you guys. That's kind of what we're focusing on.
Where are you hedged, Jay? I know you've been more in the stock market than I've been. I've gotten back in to buy some defensive, things in the
Nvidia,
recent.
right? You jumped on Nvidia?
No, I should have listened to my son. My son, who's 20, has told me twice now, Mom, you got to get into this. One Bitcoin, second Nvidia. He's like, tomorrow it's going sky up. I said, I don't have time to research it. I'm not going to throw money at something I can't research first. And boom, I missed it.
Yeah, I have a number of friends in the AI space in Silicon Valley, and they've been telling me to invest in NVIDIA for a couple of years, and I keep saying, nope, it's too late. It's too late. Well, hasn't been too late. I should have listened. I'm actually not well hedged right now. I'm probably way over allocated to real estate, but I'm comfortable with that. I feel like we're well positioned for the next couple of years. I don't see any catastrophic risk. Famous last words. And I do see more risk in other asset classes right now than real estate. I mean, I certainly have some gold. I have some precious metals. I have a little bit of Bitcoin. Not Bitcoin.
Book royalties.
I have some book royalties. Everybody keep buying the books. But yeah, it's mostly real estate, and I'm pretty comfortable with that right now.
Yeah, is horse purchases, do you think that's inflation resistant? Because I have quite a few of those as well. So I don't know if that what happens to the prices of recreational horses.
I own 14 racehorses, and let me tell you something. It's not an asset class I would recommend anybody invest in if
they're not in your backyard, right? Because are they protecting the gold?
They're not in my backyard. But if you want to sleep well at night, it's probably not the safest investment asset class.
AJ, how about you?
3 G's. What is it? Gold, guns, and grub. I don't know.
Grandma, investing grandma.
So, yeah, no, I'm obviously big real estate, but I also like service-based businesses, things like that. So I've purchased a couple businesses, and I'm about to close on another one next week. So I like the tangibles. I like real things that are providing service-based. I like product-based, things like that.
I think real estate's still the best place to be, or, I wouldn't be doing it, but I'm more than 80% allocated into real estate, and I plan to stay there because it provides income and it's an inflation hedge. And if you've got, some good leverage, you're building equity. So I'm still extremely excited. And I actually just put a property under contract today. Y'all are going to probably hit me, but I bought a single family home today, which I haven't bought one in 5 years as a real estate investment. So I do think certain areas, some single family can do well as well. But I have shifted probably 10% of my net worth into metals and ETFs like copper and palladium and silver and things like that. And then probably have moved about 10% into defensive stocks like agriculture and fertilizer and energy, AI, microchips, things that we need to bring production back to the United States. I keep thinking maybe I should put more into that stuff as I have, LP syndications I'm in start to return, just to have a nice hedge. But the thing I love about real estate is it does generally hedge inflation if you're invested in areas that have strong GDP, even if the overall U.S. economy starts to struggle, which is why, Kyle, Jay, we invest in Texas. Texas is a very strong regional GDP compared to even the U.S. GDP in many markets. So I'm still excited about real estate, but I like to think about all these things just to think, what am I missing and where do I need to hedge a little bit if these things start to happen, because there just is such a era of global shocks and kind of a disconnect from the fundamentals in some ways.
A lot of low-cost labor pouring into Texas too, though, so that's good. All right, there you go. Some actual intel, and shocker that the Drunk Real Estate Podcast recommends buying real estate. All right, you guys ready for a top 10?
Make it quick because Mauricio's not here, so somebody needs to complain.
I was hoping that Anna would cheer just could be like the exact opposite of Mauricio and be like, yeah, I'm so excited for the top 10.
Well, guys, I'm going to have to leave you for the top 10 because I have a daddy-daughter date. My daughter just turned 16. And so that's way more important than the top 10.
So before you go, give us, we're going to let you pitch something, even though you're leaving early. Go for it.
I'm excited.
Pitch something before you leave.
I'm thinking. I keep, hold on, wait for it. Newsletter. I'm going to do it again. I know it's lame. It's like the fifth time in a row, everybody. I built that up for nothing, but go check out the newsletter. We got a new one coming out, everybody. Thanks,
now you might
Jay.
want to pitch your barber because he did such a good job.
Oh, I know. So clean, right? So clean.
You look like you're straight out like Peaky Blinders or something. It's great.
I'm turning 40, so I have to look young. So
yeah, we got to plan that party, right? The two of us, 40th birthday party.
Yeah, we got to throw a bash. All right. Thanks. See ya.
Oh, y'all are making me feel old.
All right, so top 10's real quick and easy right now, kind of like Jay. So it's just the top 10 oil producers as per share of total world oil total oil production. So, all right, Jay, start rattling off. I'm sure you could do at least the top 3. Number 1.
U.S., Saudi Arabia, and Iraq's got to be up there somewhere.
Russia. Number 3 is still Russia.
Obviously, yes. Sorry.
And then number 4.
Argentina?
Canada.
Oh, Canada.
Number 4, Canada.
Canada.
Number 5, China. Number 6, Iraq. 7, Brazil. 8, UAE. 9, Iran. Number 10, Kuwait. So actually, I'm going to go right back up to the top of the U.S. just for fun. We're going to talk about the U.S. in 2023 did about 22 million barrels per day and only consumed about 20. But that was a share of 22% of the total world production the U.S. had.
We started a 20-year, $6 trillion war over the number 6 and number 10 oil producers. Jeez.
I mean, yeah. I mean, Saudi, even with their low production,
Oil has caused a lot of wars.
Yeah. So the Saudis did about 11%, so about half of the U.S. Well, almost exactly half of what the U.S. did last year. And then Russia was right behind them. So there you go. I guess with AJ, we don't really have a game. Jay, you got another joke to tell?
No, I got beat up on the last joke, so I'm not going to tell a joke this time.
I got a good joke. It's a vulgar one though, just to follow up your one. So if you have young kids listening to Drunk Real Estate, tell them to cover the ears. So a guy walks into a psychiatrist's office, completely naked, head to toe, only wearing plastic saran wrap. The psychiatrist takes one look at him and says, "Well, I can clearly see your nuts." Jay, you got anything you want to plug today?
I will put this in the YouTube description link, but I have a webinar coming up next Wednesday night for multifamily underwriting. Anybody that wants to kind of learn the ins and outs of multifamily underwriting, sign up for my webinar. We've got like 700 people signed up, which is awesome. And so go to the YouTube description for a link.
Wow, that must be a good webinar. 700 people. They must really trust you for underwriting.
No, they think it's going to be a good webinar.
I'm sure it's going to be great.
I know Anna will be in attendance. Anna, thanks for joining us. You got something to that you got going on that you want to plug?
I don't have a lot that I'm plugging right now. No, I mean, if you're interested in real estate or, financial consulting and coaching, you can find me on my website, annakelleyinvesting.com. You can follow me on social media.
And there's an E in Kelly, by the way, Kelley, for anybody that's trying to find that site.
Any socials you want to plug? Check you on Instagram.
Anna Kelley, REI Mom. So REI Mom is like my brand.
Oh, that's cute. That's almost the same as my wife's got a little catchphrase. It's great. Well, as always, I'm going to plug my wife's socials. Love plugging my wife every night. Check her out, Badass Investor, Instagram, Badass Investor on YouTube. Also, I'll throw another plug for Conference Connect, just because I got Jay's also a partner on that, and so 2 out of the 3 of us here. I feel like that's majority. Like, we can do what we want. Check out Conference Connect if you ever looking for new conferences, new speakers for your conference, or just reviews of which whether a conference is worth it to go to. Check out conferenceconnect.com. Once again, Anna, thank you so much for joining us. As Jay said, that was great. You've the insights into the economy and what's going on in geopolitics and everything. It was it was so much better than Mauricio. Mauricio would have butchered it. So it was a huge upgrade, and we really appreciate you coming out.
Thank y'all for having me. This was a lot of fun. I've been looking forward to it for a while and appreciate it. And I hope that y'all ask me back someday.
Oh, absolutely.
And I don't know if your Diet Coke is gone, but my bourbon is all gone. I got to go hit the head. So for everyone listening, I will see you next Tuesday.